AI stocks just won again. Nvidia is up 5% after hours after crushing earnings. And Alphabet, the parent company of Google, crossed over $300 in stock price for the first time after the successful launch of their new Gemini 3 model. So what is it that keeps driving up these stocks to new highs? On the surface, the stock price growth might just seem like a continuation of the AI bubble, but the actual business performance and data behind the stock price actually tells a different story. Today, I'll show you the real performance numbers, dive into the latest earnings, share what expectations analysts have for both price targets and for earnings growth, and ultimately give my thoughts on whether these AI stocks are buys, sells, or holds. So before I dive into the business behind the stock, let's just take a look at how great the total return has been for these stocks in recent years. We are basically now in the third year of the AI infrastructure build-out, and Nvidia has been the most vital part of that supply chain, and they have an incredibly dominant market position. Over the past 3 years, the total return is 1,119%. That is a 130.3% compound annual growth rate. For context, if you invested $10,000 in Nvidia 3 years ago, it would now be worth over $121,000. And it's this stock which really has driven up the entire stock market. Don't believe me? Well, Nvidia is 8.47% of the S&P 500, and over 35% of the index is tech companies, a lot of which are big tech ones AI related. As an example, we had Alphabet, the parent company of Google. The 3-year total return is 208%. That is a 45.6% compound annual growth rate. If you invested $10,000 3 years ago, that would now be worth over $30,000. However, if we look over a 1-year period, Google stock has actually started outperforming Nvidia. It has a total return of 65.1% over the past year, while Nvidia has a 26.9% total return. So along with diving into the latest earnings report for Nvidia and the latest news with Google stock hitting all-time highs, I'll do a comparison between the two and which I think may be better going forward. By the way, if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. You can get great AI-powered earnings summaries and ask questions backed with actual verified financial data, plus get 30 plus years of financials across all the key metrics you want to look for in a business, with great data visualizations to instantly understand the trends. Right now is the best time to join because we have our Black Friday sale where you can lock in 50% off annual membership. The link is in the description and pinned comment of the video. So if you like what you see and want to try it out, now's the best time to join. If the tool helps you find just one better investment, then it way more than pays for itself. So let's get right into it. Nvidia just reported earnings after market close, and they absolutely crushed it. They reported record revenue of $57 billion in the quarter, which is a 22% increase just from the prior quarter and growth of 62% year over year. This is truly impressive that they continue to keep growing from these highs. And if you're new to analyzing Nvidia, this is all due to their data center revenue. As of last fiscal year, Nvidia revenue was nearly 90% from the data center. They just hit record revenue in this quarter of $51.2 billion, which is up 25% from the prior quarter and 66% year over year. So when you're analyzing Nvidia's business, their other product segments, whether it's gaming, which used to be the entire business, it's continually getting to the point where these segments are going to round down to zero. As an investor, it's all about the data center revenue. Just as an example, here you can see the data center revenue of Nvidia over time. In 2023, that was $4.2 billion in a quarter, and that has continued to ramp up, now at $51.2 billion. All of Nvidia's stock gains is attributable to this growth. And as we go on throughout the video, I'll explain how it makes it actually pretty simple to analyze Nvidia's stock, but it also creates potential risks down the line. Right now, it seems like growth is set to continue. For Q4, they gave outlook expecting revenue to be $65 billion in the quarter. That is continued high growth, going from $51 billion to $65. And by the way, guys, this is not just top line revenue. This company prints cash to the bottom line. They have long had 70% plus gross margins. And for Q4, they're expecting gross margins to be around 75%. And Nvidia is basically trying to flood the zone and build as many partnership relationships as they can with their customers, which is primarily the large data centers. That includes hyperscalers like Microsoft, Amazon, and Google, plus companies like Oracle and Meta. And then the newer AI model companies, whether it's OpenAI, Anthropic, xAI, etc. So Nvidia's customers really are the largest and most capitalized big tech companies. And that's the only reason why Nvidia is able to continually ramp up their revenue. Nvidia's business is the capex of these other big tech companies. And as of right now, that is only continuing to ramp up, and it seems like that will continue for at least the next 1 to 2 years. So now let's do a big picture look at Nvidia. So the current market cap is $4.5 trillion. They're the most valuable company in the world right now. And that's prior to going up 5% after hours. Based on GAAP EPS over the trailing 12 months, the PE ratio is 52.9, but that becomes reasonable if you have continued expectations of high growth. Speaking of growth, let's look at the business metrics of the company. Revenue per share has grown at a 10-year compound annual growth rate of 38%. But as you can see by the quarterly revenue per share, that has only really started ramping up since 2023. If we take a look at the 3-year compound annual growth rate, it's 70%. And this is not including the 3 most recent quarters. As you can see, they just hit a new high, and based on that guidance I gave earlier, they're expecting an even higher number next. Net income per share growth has been stellar. They just hit $1.31 in the latest quarter, and not even including this fiscal year, it's been growing at a 3-year CAGR of 96.5%. And a lot of this is turning into free cash flow. We are in a continued trend of high growth. 3-year CAGR, 96.6%. And this means that Nvidia is starting to build a fantastic balance sheet because they are printing money. Shareholder equity has now grown to just under $120 billion, so they have far more assets than liabilities. They have $60.6 billion of cash and short-term investments, and this is why they've been so aggressive investing in the AI ecosystem. They've recently invested money in OpenAI, they've invested in Anthropic. If we take a look at the net debt for the company, it's about negative $50 billion. So again, far more cash than they have in debt. And relative to the big tech companies that are their customers and the actual semiconductor manufacturers, whether it's TSMC, Nvidia has very low capex. That's because they have a fabless semiconductor model where they are the designers, they don't manufacture it themselves, so they don't have to build these large fabs. And it's why they have such a high margin, high free cash flow business. But the big question with Nvidia is, will this growth continue? If we take a look at the analyst expectations for growth, they're expecting earnings per share to grow 50% next year, followed by 25% the year after, and then they're expecting it to stabilize, which would mean if you bought Nvidia at today's stock price, it would be a 21p ratio based on 2029 expected earnings, which really is not expensive for a high growth, high margin business with a dominant market position. However, these 0% in the future years really just highlights how much uncertainty there is on the long-term demand for new data center revenue at Nvidia. And that's where we get into the key risks and uncertainty. The current consensus price target for Nvidia stock is $251, which implies it's 34.75% undervalued at today's price. In fact, the lowest price target is $200, which was above the current stock price before going up after hours. So you might say, Zach, you've been awfully positive about Nvidia here, and it's deserving. It's one of the best businesses in the history of the world. This level of growth over the past 3 years, it's unprecedented, and they are a core part of fueling one of the next big technological revolutions. But that doesn't mean there's not risk. There definitely is risk, because in order for Nvidia to keep growing, all of their top customers, which are the big tech companies, have to continue to progressively invest more and more and more into data center infrastructure. And there is inherent uncertainty about how long that continues growing, whether or not it levels out at a sustainable rate, or if the companies at some point in the next 5 years cut back on spending. And if that happens and there is any kind of AI-related bubble, Nvidia stock, it's going to get crushed. That could even happen in the scenario where the AI revolution ends up being even more significant than we thought. You could end up in a scenario where Nvidia's stock price gets so high that it could see 5 to 10 years of no growth. And as Nvidia gets to a $4.5 trillion market cap, you're starting to see more and more conversations about how much more can the company grow. And a lot of that's going to depend on the economics of the AI ecosystem and how much they continue to invest in AI infrastructure. One example of that is Alphabet, the parent company of Google. They briefly crossed $300 today and hit a new high in all-time stock price at $303.68. And like Nvidia, this growth is deserving. The earnings per share of Google have continued to grow, and they just hit an all-time high in the latest quarter. Analysts are expecting continued high growth in future years, averaging double-digit earnings per share growth. Based on next year's earnings, Alphabet's trading around 26 times, and based on expectations for 2029, the P ratio based on today's price is 17.4. But Google stock has its own set of questions. Alphabet is a fantastic growing business. The 5-year CAGR revenue per share is 19.4%. We're seeing similar growth in net income per share. Alphabet has long had one of the best business models in the entire world. They print cash with Google search advertising, and that's allowed them to build up an incredible balance sheet with $386 billion of shareholder equity. They have $98.4 billion in cash and short-term investments, plus deeply negative net debt of negative $64.7 billion. So for a long time, Alphabet hasn't had a ton to invest in. But now with AI, they have a clear opportunity which requires a lot of capital and is right in their wheelhouse, and they are going big. They have ramped up CapEx significantly. So that's why, despite having a lot of revenue and earnings per share growth, the 3-year CAGR of free cash flow is only 5.58%. And you can see this by the ramp up in their quarterly capital expenditures. That's gone up to $23.9 billion in the latest quarter, and they continue to guide to increasing CapEx. But Google is actually an interesting one because they're not entirely reliant on Nvidia. Google has been all in AI as long as Nvidia has. And despite it only showing up in the fundamentals over the past 3 years, if you've been following the company, this is something they've been doing for more than a decade. They acquired DeepMind probably more than 10 years ago. And they're also vertically integrated, and they have been designing chips. They call them TPUs. And this is used a lot through Google's internal AI data centers and through Google Cloud. So this actually gives Google quite the advantage in some ways, where they can avoid a lot of the Nvidia margin tax, and they can build a lot of the infrastructure with their own technology without the big margin going to Nvidia. And that brings up one of the potential risks for Nvidia. They're really just the chip provider. Now, don't get me wrong, they have a great business and they have a pretty good moat with CUDA and all that kind of stuff. But these big tech companies, they are spending a ton of money, and they also have fantastic talent. And like Google, over the long term, they probably don't want to be giving away a ton of those billions of billions and billions of dollars of spend towards Nvidia. So they're going to want to market, they're going to want alternatives, and some of them will want to design their own chips. And this starts to go back to one of the most important conversations we need to have, which is the AI bubble. And where does the long-term value actually end up accruing? I actually think a lot of this will end up playing out similar to the dot-com era and the internet revolution. The long-term value of the internet did not accrue to the chip companies. It was all of the new businesses that became possible off the back of the technology. Things like Google. And things are slightly different now. Don't get me wrong, Nvidia is a fantastic company. The classic example people have been bringing up for really 3 years now with Nvidia is Cisco. They had incredible, reliable earnings growth. Stock price boomed during the dot-com bubble. After it popped, though, earnings collapsed. But then they did recover back to their old levels within a few years. But the stock price, it took 25 years to get back to those levels. And the earnings per share, the actual money the company was generating, was more than 5 times than it was then. But it doesn't trade at such an aggressive multiple. Now, luckily, when we're talking about Nvidia, the multiple actually isn't as aggressive as the dot-com era. They are being priced much more reasonably based on their earnings. But as we look decades out into the future, I don't think Nvidia will be the most valuable company in the world. It will be the companies that actually create and use AI to create innovative applications, drive new value, and Google could be an example of that. But really, the future with a lot of that is pretty uncertain at this time. But the one thing I am certain of is that, like the internet, the actual value creation will be far more than we can even think of today. But there could be a few years along the way where, in terms of economics, we could have the valuations quite off. And that's the potential risk you play when you're investing in these stocks. So as I wrap up this video, where do I sit on Google and Nvidia? Are they buys, sells, or holds? I'll start with Google since that's a stock I actually owned. I bought a big chunk of it during the April 2025 tariff sell-off, and I have continued to hold it that entire way, but I haven't really added to it that much. And my stance right now is that it's a hold. I would not trim this position because I do think there is a lot of long-term compounding left. But given how volatile the market can be at times, and how the AI bubble narrative is very emotional in people's minds, I think there could be quite a few opportunities for dips in these AI-related stocks. So over multiple years, I would consider myself a net buyer, but right now, I'm a hold. Nvidia is a stock I don't personally own, but I have been following it and covering it. And in hindsight, I pretty obviously should have bought it because I knew everything I needed to know it would do well for a few years. But I see the 5 to 10 year horizon for Nvidia being very uncertain. So for 2026, Nvidia is not a sell, no way. If you already have an investment in the company, I would say it's a hold, but you can make a very compelling case that for the next 1 to 3 years, Nvidia is still a buy at today's prices. And that's because if you're following the entire AI ecosystem, they're still ramping up. We're still in early innings. But the risk with Nvidia is if at any time there's a trough of disillusionment or if a lot of the companies that are buying Nvidia chips, especially the newer ones that are losing money, whether it's OpenAI, Anthropic, or XAI, if they can't continue to grow purchase orders, then there could be a risk around Nvidia stock. But I think for the next 1 to 2 years, you're going to be good. With that said, you should do your own research before making any investing decisions. This is just my opinion, and I'm giving you my insight and how I think about these things. If you want to use the tool I showed throughout, it's all available at dividenddata.com. Right now we have our Black Friday sale where you can lock in 50% off annual membership. It's the best deal we ever offer. The link is in the description and pinned comment of the video. And if the tool helps you find better stocks, then it way more than pays for itself. With that said, thanks for watching, and I'll see you in the next one.